Hello and Happy New Year. Welcome to this 10-year capital market assumptions presentation by First Business Bank. My name's Matt Rice. I'm Chief Investment Officer at First Business Bank and really excited to show everyone our capital market assumptions for the next decade. With that, as we work our way through the presentation, just as a quick summary, here's a scatter plot of how they all fall out. This is kind of taking the output of all of this entire presentation and just sharing it on the first slide. So these green diamonds here represent really our fixed income forecast. So we have everything from cash to bank loans and everything in between, and from a 10-year return and volatility forecast. The purple here represent represent the equity asset classes. And how they're going to fall for the next 10 years. And then we look here at the orange, which represent our alternative asset classes. I'm not going to spend a lot of time on this slide because this is the high-level summary. We're going to dive in to each one of these asset classes and explain the forecast for each. So our methodology, to start with, a bit of an important building block to all of this is inflation. And when we look at really the 10-year nominal yield, in treasuries, it's about a 4.17. We look at a 10-year treasury inflation protected security yield of about 1.9. When you kind of look at these two numbers, the difference between them should be the market's expectation for inflation over time. So this is the process we're using. When we look at it now, it's about 2.26. This break-even inflation rate, we call it, and it's a little bit higher than what we're running now, but we expect really inflation to come down to this level over the next 10 years. You can see historically how this metric would have broken out. Back in 2008, for example, we did deviate from this methodology because we noticed that there was this really strange dynamic happening that was really more a function of illiquidity in the Treasury inflation protected markets than we thought like a real issue going on with inflation. So pretty much most of the time periods throughout history we have used this forecast period with the exception of 2008. And we actually did, I believe in 2021, use a little bit higher inflation rate than predicted by this when we didn't think that the market had started to price in a lot of the inflationary aspects of the pandemic and the aftermath of the pandemic. As we work our way here to cash, cash is currently yielding about 4.58%. We expect over time that yield to work its way down towards the inflation rate, and that cash, like it's done throughout history, will give us pretty close to a 0% rate of return net of inflation. And so with that, we're going to average the current yield of about 4.58 with a longer term expectation of 2.25. And then we think between now and the next 10 years, we're going to work our way down towards that 2.25. So that gives us about a weighted average of about 3.4. So we expect cash yields to continue to come down a little bit over the next 10 years from where they are currently. Treasury inflation protected securities, tips are really what we're able to do here is we talked about our inflation forecast that we just developed, which is about 2.25%. We're going to add that really to the real yield of the TIPS index. And with that, you can see that we're going to get to about a little over a 4% return, 4.2% rate of return. So if you buy TIPS now, we expect you're going to earn just under a 2% real yield. And then on top of that, we expect them to appreciate with inflation over that period. Investment grade intermediate bonds. This is a category where if you look here at kind of the model and the prediction, it's very, very close. And it's a very simple model. What we're doing is taking a look at the current Bloomberg US aggregate yield to worst. It's about a 6.4. If we use the best fit regression formula of comparing kind of historical yield to worst to the next 10-year rate of return, you get an extraordinarily high R squared of about 0.94. So the current yield explains about 94% of the return over the next 10 years. So that's a really, really good forecast. In this particular case, we're going to use that, just the current yield to worst, and that gets us a 4.6% return forecast for the next 10 years. When we look at the next asset class here, short-term investment grade bonds, it's basically just a blending of the money market or the cash rates in intermediate duration. So it's right in the middle of about a 4.2%. We look at the muni bond side, it's a similar dynamic. We're getting to a yield to worst of just about 3%. The one difference here in muni is that since you're not paying federal income taxes, we either need to kind of when we're comparing it to taxable bonds, we either need to bring the return down on taxable bonds, or we need to boost up the forecasted return on muni bonds so that we can compare the two from an apples to apples perspective. So we do expect munis to return about a 3% rate of return over the next 10 years, but when we compare that to kind of a tax equivalent type of return relative to taxable bonds, it's about a 4.8% return. And so that's what this tax boosted return means. So when we're determining taxable clients and we're kind of saying, should we invest in munis or should we invest in taxable bonds, really we're looking more at that 4.77 on an apples to apples basis, which factors in really the highest marginal tax rate. Typically the people that invest in munis are in the higher tax brackets. So with that, you can see here how the model has predicted the return over the next 10 years, and it's a pretty tight, an R squared of about 0.9, and that's a nerd way of saying that 90% of the return can be explained by this model and the other 10% can't. So it's not quite as high as the investment grade intermediate bond side in terms of a model explanation, but it's still pretty high. We look here at high yield munis. These are lower credit quality municipal securities. It's a similar dynamic, except we have higher yields, higher risk. So there is a little bit higher deviation here in terms of the model and the prediction. But overall, the model, the explanation here of the model is about 73%. So there's a little bit more unknowable here in terms of a forecast. That's okay. But at the end of the day, we expect about a 4% rate of return here, but when we tax adjust these high yield munis, because you're not paying tax and you're comparing them to taxable investments, we get to a higher 6.4% return. And then we have here high yield bonds. If we're looking here at the way this plays out, we're kind of baking in credit spreads, comparing them to forecasted returns. So on one hand, when credit spreads get higher, that's a good thing for high yield bonds because we expect returns to be higher. But on the other hand, we expect defaults, that risk is higher. Therefore, we expect defaults to go up and recovery rates to go down over that period. So it's not really a linear relationship. So when the yield on high yield bonds doubles, doesn't mean your return doubles because you're going to have probably higher defaults. And so this model sort of breaks that in, factors that in to the dynamic here. So we have a current yield to worst of about 7.1% in the high yield bond index, and we're kind of factoring in about a 1.1% loss drag that comes from default. So credit spreads are pretty tight or low relative to kind of historical norms, and yields are relatively low compared to historical norms in the high yield space compared to, we go back out here, these are some periods during the great financial crisis and other periods where nobody wanted to invest in high yield bonds, and high yield bonds were an excellent investment. And but here you can see kind of where things are looking at from an explanation. So we're kind of on the lower side of return expectations compared to historical norms here in the high yield bond space. And then here's how the model kind of predicts the return. So you can see that there's been a little bit more error here over 10-year forecasting periods. Bank loans are similar to high yield bonds in some respects, similar to short duration fixed income and others. So we're expecting really here bank loans, which are currently yielding about 9%, to come down a little over 1% over the next 10 years, kind of consistent with what we're expecting in money market returns as interest rates kind of trend down over the next 10 years. And then we're going to factor in these bank loans are high yield issues. We expect that they may lose. They have some defaults and less than perfect recovery rates here. And so we're building in really a 1% kind of drag or loss that we're the same one that we're using for high yield bonds. So that gets us down to really that 6.7% rate of return. Large cap U.S. equity right now, valuations appear relatively high, which for the next 10 years means that we're probably going to have a meaningfully below average 10-year return of about 5.6. And this model down below kind of compares price to earnings ratios relative to returns for the next 10 years. So, if we look at other periods throughout history, 1998, 1997, 1999, over the next 10 years, 2000. These were periods when market values were PE ratios were relatively high, and we had over the next 10 years we had reasonably low rates of return. Here are others like 1978, 1980, and so on and so forth, where it was the exact opposite. PE ratios were really low, and we had really high returns over the next 10 years. So keep in mind that 10 years might sound like a long term, but it's pretty short. Over the next 20, 30, 40, 50 years, we expect closer to double-digit returns really in U.S. equities, and that's more important for our clients that have 20, 30, 40-year, 50-year investment horizons. But this is a 10-year forecast, and over the 10-year, we do expect there to be a little bit below average, kind of historical. But again, we do expect closer to double-digit returns over the very, very long term in the large cap U.S. equity space. And then we have here kind of the model, the forecast, the prediction. You can see throughout history this has been done a reasonable job, and you go back to some decades here where we're closer to 18, 19, 20% returns in a decade, and we actually had one here, the coming out of the late 1990s, from 1999 to 2008. We actually had a negative 10-year return. So we had the tech valuations being really, really high on the front end of that 10-year period, and then we had the great financial crisis at the end of that 10-year period, which actually gave us a negative rate of return during that particular period. But overall, you can see kind of where things fall out now. We're closer to the lower end of the range, but again, just keep in mind 10 years is not that long. And that we're really, when we're investing for 20, 30, 40, 50 years for most of our clients. And then we look here at large cap versus mid cap, small cap, and then the entire breakout here. There's a couple guys named Black and Litterman developed a method for taking volatility and correlation of various asset classes, comparing them to a broader market index, and then kind of building in what the implied return is for those areas. So if we have a large cap return of 5.6%, and we kind of look at the volatility and the correlation of these other categories relative to large cap, the market itself is implying that we have about a 1% higher return in mid and small cap, more even in small cap than mid cap. And then when you put the entire all cap together, the entire U.S. market is a function of about 70% large, 20% medium, and 10% small cap. When you kind of rope all those together, that gets us closer to a 5.8% forecast. Again, next 10 years, we expect much more like double-digit returns over the long term in equities, but over really the next decade, a little bit lower than kind of long-term historical norms. And then we have here U.S. equity, international, and emerging markets using the same Black-Litterman methodology, where we take a look at the U.S. equity return and we kind of look at volatility and we look at correlations. That gives us close to about a 1% increase in the international and emerging, a little bit more in the emerging markets relative to the U.S. markets. When we kind of look at things overseas in the international markets and the emerging markets, those markets tend to, or at least right now, have a lower valuations in those markets. U.S. has been doing really, really well, has really dominated over the last decade plus. Those other markets have stayed behind. We do think that there's more upside potential, at least over the next 10 years, in international and emerging. But when we look to build portfolios, there's still, we're looking to maximize risk-adjusted return in the U.S. Markets on a risk-adjusted basis have been quite attractive, and we expect over the next couple decades to continue to be so, even if over the next 10-year period we're looking at a little bit below long-term historical norms. Real estate, we look here, the 10-year REIT forecast at a 5.9%. That's really a function of the current yield that we're seeing in real estate from a dividend perspective, and then we're factoring that real estate will be able to increase its yield to the tune of about inflation, meaning rents will go up with inflation. And so over time, the rate of return is really a function of the income plus the appreciation in the value of the real estate, which is a function of an increase in the ability to increase rents with inflation over time. So that gets us to a 5.9% return. So you can see that's even higher than our 10-year forecast right now for U.S. equities. So an alternative asset class, we think that's positioned reasonably well relative to U.S. equities and others for the next 10 years. Commodity futures, similar story here. Commodities, it's a futures contract, so you're not actually buying oil or keeping it in the basement or anything like that. You're buying a futures contract. So with a futures contract, you start off with money that you need to collateralize that futures contract with. So it's essentially you're agreeing to buy something in the future at a set price, essentially. And so if the value of something goes up or down relative to that initial price, that's how it's going to drive your gains or losses investing in that forward or futures contract. But we start off here with the collateral of that futures contract. You can invest in a money market, and there you can earn maybe a 3.4% return, consistent with our money market rate of return. And then we're assuming the futures contracts themselves will generate a rate of return by rolling those to the tune of about inflation. We're factoring in really no additional positive roll return on top of inflation over the next 10 years. So with that gets us just under a 6% rate of return. We're not invested in commodity futures in our client portfolios because we necessarily think it's going to be a really high returning asset. Over time, we're investing in it because it's a great diversifier. When stocks and bonds go down, commodity futures often go up because commodity futures tend to respond well to unanticipated inflationary forces where stocks and bonds don't. And geopolitical issues, sometimes commodities do well in that type of environment. Stocks and bonds do not. So commodities really exist in our portfolios based on their diversifying properties, not so much a really, really, really high long-term rate of return expectation. And then we have liquid alternatives. That's our, we have a liquid alternatives portfolio we're currently invested in, fairly low on the volatility side, well diversified. When we look at the volatility of our liquid alts portfolio, it's in that 78% cash, 22% large cap U.S. equity type of range. And when we look at the expected return of that portfolio, we get to about a 3.9. And then we're factoring in that our liquid alts managers, we think, will be able to add about a 1% rate of return, a risk-adjusted return on top of that. So we get to really the 4.9%. So this is a piece that we have in some client portfolios that help just diversify. Well, that's our presentation for today, our 10-year capital market assumptions. We're really excited about the new year. In the meantime, please reach out to your wealth advisor, your trust advisor, or your portfolio manager. We love to talk to you. Again, these capital market assumptions are going to be the building blocks of portfolio construction for us, building blocks of what we're doing from a financial planning perspective. So these kind of drive a lot of the other things. These capital market assumptions are kind of behind the scenes on a lot of other things that are going on, in terms of driving your portfolio decisions and your planning decisions. So with that, thank you so much. I appreciate you spending the last 18 or so minutes with me. Please reach out to us at any time with any questions.